Okay, just setting up the live streaming. Okay, great. Just setting up the live streaming now. Takes a few minutes. Okay, so I will share my screen. So what I'm going to be talking about today is how to calculate real property returns, because I know there's a lot of confusion around this. And a lot, some people look at just rental return as one metric, or they might try and look at return on capital employed. But they're too broad brush. It's like using a sledgehammer to crack a nut. It doesn't really give an adequate answer and doesn't really allow you to compare different types of strategy against each other, different types of property, different types of funding, or so on. So I'm going to show you exactly how to do it. Okay, so am I? My name is Keith Griggs. I'm a chartered accountant. I'm also a fractional CFO. Um, so I often help businesses um, understand their data a lot more and use that to grow their company a lot faster. And also, I help people invest in property. I help them get better returns and build wealth that way as well. So we've just had Nikita join us. Hi, Nikita. Good to see you. Okay, so what we're going to cover today, five main steps. The first is the rental yields trap. So just because a property yields, for example, 6%, that's not enough data to know whether to buy it or not. And simple mistakes could cost investors thousands of pounds. Two, so we're going to look at the professional analysis method and what the pros actually use, instead of most people who are just amateurs and don't really know what they're doing. Then we look at a real deal. We look at a Birmingham property for 250,000. We will look at two methods of financing that same property and see how that affects the return. Then the fourth stage is to look at my suggested action plan to you, how to implement this immediately for better investment returns. Then we can have an optional elevator pitch networking for the people around at that time. And please, if you've got any questions, please put them into chat. Okay, so rental yield lie. Does 6% equal 6%? They look identical, but one strategy will make you money, the other could lose you money. So this is why so many people underperform when they're buying property. They just really don't know what they're doing. And if you don't understand, so if you just focus on this one thing, rental yield, uh, there's several things wrong with that. One is it just ignores the timing of cash flows. Like, do you get your money now or do you get it in 5 years' time? There's a massive difference because the time value of money now is a lot more than in the future. That's why people use discounted cash flow techniques, and that's why, if you look at futures on the stock exchange, the prices are different. Also, rental yield misses hidden costs. There's so many different costs, like legal fees, void periods, etc. So this could massively reduce what the stated rental yield is. Also, it doesn't account for the exit strategy. Maybe you plan to sell it in 5 years' time after it's accumulated a lot of capital. That's someone else joining us now. So that's not reflected in the rental yield. Hi, Asha. Good to see you. So, and the other problem with the rental yield is it doesn't compare different time horizons. So how do you compare something you flip and get the money in 3 years with something you buy and hold for 10 years or longer? So rental yield doesn't give you any framework where you compare that sort of strategy. So that's why if you just focus on rental yield, it can actually destroy your wealth over time. So, what professional investors, what property, large property companies use, if they have a good accountant, is time adjusted returns. So, this just shows your real profitability. It accounts for all of your cash flows and it compares different time horizons. So, it's not just when you get, it's not just the amount of the cash flow, it's when you get it, which is vital. And it shows your true return. And then also by doing this, you can also compare, is it best to invest your money in property? Is it best to invest in equities? Is it best to invest in Bitcoin or futures or whatever the alternative use of your money is? So timing matters, same property, different horizons. So if you buy a property, so in these two examples, suppose you can get 30,000 return. Now, if you buy over, if you get that return over 3 years, that's 10,000 a year. If you get that return over 10 years, the annual return is only 3,000. So it's a third, even though it's the same return. So that's why timing matters. So of course, uh, the one which is better is the one where you get your money faster. So someone else just entering. Hi, Claude. Good to see you. So in this example, this person bought three properties just looking at the rental yield, and they all showed a 7% yield on paper, which thought was fantastic, obviously compared with putting your money in the bank. But uh, in fact, she lost 35,000 over 5 years, compared with if she'd have bought different properties using proper time adjusted analysis. So with property, the amounts of money involved can be quite large. So it's very important to make very intelligent, data-driven decisions. So these are the 5 steps to for professional analysis. Step one is to work out exactly how much money you're going to part with initially. So look at all your costs, purchase price, stamp duty, legal fees, refurbishment. Maybe you pay saucer fees if you bought the lead from a saucer. All your costs, that's your initial investment. Then after that, you look at your projected annual cash flows. Obviously, rent is the biggest one, but then of course you've got to take other things into account, like all the void periods, maintenance, management fees, insurance. What I normally do as a rule of thumb is whatever the rent is, if the rent is £1,000, I say 25% for to cover voids, maintenance, management fees, just as a rule of thumb. But obviously it depends on the type of property. Then you have to estimate your exit proceeds. So be realistic about the sale price. Most people always want more than they can get. Take off a few percent for agent fees, legal costs. So these are your main flows. Then you have to look at the timing. When exactly do you receive each cash flow? And then you have to adjust for the time element. So I'll give you an example in a minute. So this actual property in Birmingham. So with any analysis, you can go on forever. Uh, this example does consider stamp duty. Things change all the time. Maybe, if you're looking at this in a year's time, stamp duty may have changed, and all these other taxes. So it's more the principles I'm showing you now rather than the actual figures. And I'm not looking at capital gains tax because that depends on whether you're high rate or low rate. I'm not looking at corporation tax because, again, that depends on the turnover of your business. And also, you may or may not buy this in a company. You may buy it in your own name. So I've just excluded those things just for the purpose of these slides. But if I was helping you in practice, of course, we'd have to consider that as well. But in general, as a general rule, I would say if you buy a new property or buy any property from now onwards, it's better since Section 24 was introduced in 2015. It's normally been better to buy properties in a company because George Osborne's effectively penalised the tax treatment of when you buy it as an individual. Okay, so what is this property we're going to talk about? Three-bedroom Victoria Terrace. I mean, it's irrelevant in terms of the numbers, but it just maybe helps you visualize the scenario a bit better. Birmingham needs £15,000 refurbishment, so it's normally when you buy a property to rent out, you normally have to spend a bit of money on refurbishment, at least decorating it, and maybe it needs rewiring, new kitchen and bathroom, that sort of thing that can make it much more attractive to tenants and means you can get much higher rental uh, return, and also it means you get fewer voids. So it's normally worth spending a bit of money on refurbishment. Okay, so let's say it was on the market for 275 and we managed to negotiate them down to 250. And let's say we can rent it out, or the current rent at the moment in its bad unrefurbished condition is 1,100 a month. But we think by refurbishing it, we'll be able to increase the rent to 1,300. And we've done some research on that on Rightmove, looking at comparable properties. So, hang on a second. I just want to check. Yeah, I just wanted to check one live stream. Okay, let's go back to sharing. Okay, so these are the figures. So this is the scenario. This is the actual data. Now, what I'm doing in this, for the purposes of this presentation, I'm comparing buying it outright as opposed to getting a 75% mortgage. I am continually amazed how many people I speak to who want to pay their mortgage off and just buy things outright. I think that is a massive mistake. It does reduce risk slightly because they don't have to worry about interest rates going through the roof, but it dramatically reduces their returns. So, in my opinion, it's never worth it. I think you should always mortgage at a reasonable loan to value. Normally, I'd say 75% loan to value, 75% mortgage. And I'm going to demonstrate this now with this calculation. So in both scenarios, value of the property is the same, 250,000. The stamp duty is the same, legal fees, survey and valuation, refurbishment. So the total of all those is 282,500. Okay, so let's say person A just bought the property for that. Person B got a deposit of 75%. So they still had, so in terms of that 250,000, they had to pay 25% of that is 62,500. That was their deposit. And then the rest of that was they got a mortgage, but all these other things are the same, except they had to pay an extra amount mortgage arrangement fee, for example. So they only have to invest 96,000. So a lot less. So this is step one. This represents the upfront money that the investor had to pay in these two scenarios. Step 2, look at the annual cash flows. So they both receive the same rent, 1,300 a month, 15,600 per annum. Both got the same void periods, management, maintenance, insurance. So if you do it outright, total expense is 3,415 minus the rent is 15,600 gives net annual incoming cash flow of 12,185. With a mortgage, it's exactly the same, except there's mortgage payments to take off. Let's say it's 3.6% on 187,000. That's 6,750 a year. So their annual cash flow is less than half. It's 5,435. Okay, they're the two scenarios. Then the exit strategy. Let's say, for example, they sell it over 5 years. Now, this wouldn't normally be the best strategy because normally what would happen is I'd say normally when you get a mortgage, you get like a 2-year fix at a big discount, and then you can remortgage in 2 years' time. And normally by that time the rents have gone up with inflation. The value of the property has gone up, so you'll be able to not only do another 2-year fix, you're also going to be able to draw down equity. I know the market's been a bit flat for the past 5 years or so, but going forward, at some point, property prices are going to start going up again. So every 2 years, in other words, you can draw down more money, increase your mortgage, which gives you more cash, which you can then use to buy more property. So this is the sort of worst case scenario. I've just, for the case of simplicity, I've just assumed that we sell it over 5 years. And the reason I did that is because I just wanted, because capital growth is probably the main wealth growing aspect of buying property. So the increase in value has to be included somehow in any cash flow calculation. So I've assumed for here that we sell after year 5. So the proceeds are the same. So let's assume we sell for 320,000. They're the selling costs, 5,500. So the net sales proceeds are 314,500, which is the same in both scenarios. In this case, I've assumed pay off the mortgage balance of the same amount you borrowed, which gives you proceeds of 127,000. Again, I've not considered capital gains tax for the purpose of this presentation, but of course, you'd have to consider it in practice. Okay, so this is what we have in the two scenarios. This is your net proceeds. So you get this money in at the end of year 5. You get, this is all your rental inflows for the 5 years. This was your initial capital invested. This was the net profit overall. So you see in scenario 1, you do actually make more profit because you have, in absolute terms, because you get a higher rental inflow because you don't pay any mortgage interest. But you did pay a lot more money, maybe you paid about 3 times as much in your initial capital invested. So you have to look at the time adjusted returns. So in year 0, they were the two amounts, 282.96, and initially, then these are your rental returns every year, and then this is your rental return plus your for that year plus the proceeds on sale. And this shows that the annual internal rate of return of getting a mortgage is 11%. And in case you're wondering how I calculated that, I can show you on a spreadsheet, one I prepared earlier. So these are all the same figures I showed you earlier. So this first column is obviously buy outright. This is using a mortgage. These are the cash flows, annual. These are the selling. So these are the same. These are the cash flows. So what I do, so this is the crucial formula. C55 internal rate of return. So so in Excel you can do equals IRR, stands for internal rate of return, and then I'm just looking at these flows from 48 to 53. So I'm looking at these figures. That's year 0 now, year 1, year 2, year 3, 5 is 6% return, whereas the internal rate of return of these figures is 11%. An internal rate of return is defined as what rate of interest would you have to use using discounted cash flow techniques for all these cash flows to give you a 0 net present value. But in any case, it's double. So in other words, if you use this strategy of the mortgage, you will grow your wealth twice as fast on average. So yeah, average approx doubles your returns in this scenario. Now, you may be thinking, oh, well, is it better to invest in property or is it better to invest in equities? Now, I just Googled it and I found this online. It's quite interesting. So this shows all the total returns. So it means with property includes rent as well as capital growth. The FTSE, the red one is FTSE, and that includes dividends as well as capital growth. As you can see, if you start at this point, 2015, so from this 7-year period from 2015 to 2022, property's actually outperformed. The other thing you might notice is that it's a lot smoother. Property doesn't sort of go down 40% in one day. So this was obviously the start of the pandemic. Equities crashed, property stayed relatively stable. This was Brexit, probably, that went down there. Obviously, if you bought at the bottom, with timing, you can do really well with equities, but it's sort of like gambling because we don't really know what's going to happen. So I think property is not only safe for return, it's more profitable. And don't forget, this is just it's not even considering leverage. This is considering if you just invest 100% in property and just buy it outright, you're still better off than equities. And obviously, as we've just seen, if you use mortgages and leverage, you can double that return. So all good stuff. So please, if you've got any questions, please just put them into chat. Just checking, I haven't got any, can't see any. Okay, so why this deal work? I mean, it is important to get a relatively high yield. I mean, I think it is difficult buying in central London because the yields are so low, the property prices are so expensive. So these things are always a bit easier outside London. Rental yield is important because that's money coming in every month. And if you rely totally on long-term capital growth, you might be squeezed with your cash flow because you might find mortgages, voids could mean you have to put money into it every month and not being able to get your money out until you sell the property. So I would recommend a healthy rental yield as well if you can. Also, if you can get below market purchase, which is not as necessarily the same as below asking price, you want one below market, so then you get the gain when you actually sell the property or if you remortgage. And I can also help you acquire below market value properties. Then look at ways to value add using refurbishment, which will increase the capital value and also the rental income. Look for areas of solid capital growth. Don't look for areas where it's sort of dying industry, people are moving away and so on, because that's not going to go up in value. Look for strong rental demand so you can rent it out easily, and look for a clear exit strategy. You want one you can sell easily, for example, where there's good demand for owner-occupied property. So what I recommend for your next steps is to analyze your current properties using this technique. Uh, Make sure you factor all your costs and all your timings. Make sure that you set your standard, minimum threshold, and that you compare properly time adjusted returns. So here are some advanced strategies to increase your wealth even faster. Leverage, use leverage. You saw in this example how mortgages changed everything. Now, if you can work with investors who can lend you money as well, that can also help considerably. Um, Portfolio strategy, look at your risk return optimization. So I would say it's normally better not to put all the eggs in one basket. Maybe try sort of buying lots of cheap terraces up in Liverpool. You could be exposing yourself to a lot of risk, but maybe if you have different types of properties, different geographical areas, you would be a lot safer against any sort of downturns in the local market. Look at tax structures. Normally, limited company is best. The safest, of course, is to have each property in a separate limited company. Then, and then you could just sell the company rather than sell the property. One thing, and also if there was a particular issue with that property and that company had to go into liquidation, it wouldn't affect your other assets. Um, Professional guidance, so hire an expert such as myself to help with this sort of optimization. I think because of the numbers involved, especially over 5, 10, 15, 20 years, which is how you should be thinking in terms of your property portfolio wealth building. It's very important to get everything set up properly at the start and to grow things in the most optimal way, because even getting something slightly better is going to have massive returns because of the compounding effect of time. Bottom line, most investors just look at rental yield, basic 100k investors use basic analysis, whereas 1 million plus investors use more detailed optimization and strategy. So if you want me to take a look at your portfolio and to review it, I've got some limited slots. We can look at a analysis of your properties. We can identify any opportunities you're missing, look at tax efficiency, and also look at portfolio growth. So I'm offering that totally free of charge for a 30-minute review. And if you're interested in that, or if you just want to talk to me about anything, you can email me at keith@propertycfos.com, or you can just chat in the chat box on my website, and that's propertycfos.com, which is here. And then if you just chat here, that will go directly to me, and I will answer. Just gives you a bit more information about me. Also, there's a couple of videos there about tax, and you can also look at my show. Also, case study. Does that work? There we go. So, key takeaways. One, just looking at rental yield is misleading. Two, time adjusted returns show the true situation. Three, set high standards, use a minimum threshold. Four, make sure you factor everything in. Common analysis mistakes to avoid. Being too over optimistic, especially with the rental figures, you've got to be realistic. Look at the actual figures achieved on Rightmove, and make sure that you have something in for void periods because you will get them. And also make sure that you budget a good amount for maintenance. Here it says 1,000 per property, or if it's older than 1,500. But how long's a piece of string? Um, I personally, you could also look at 25% of your rental income for voids, maintenance, management fees, and so on. And you could manage it yourself for free, but I think you'll find it very stressful. So I'd recommend factoring management costs. Having that buffer between you and the tenants can just protect you from a lot of stress, because instead of dealing with an angry tenant, you deal with like a nice, friendly letting agent. So what I recommend now is apply this analysis to your current portfolio, set your minimum threshold, then source and analyze 10 potential deals in the next month. Over the next 3 months, complete your first acquisition using this strategy, and over 12 months, build a portfolio of properties with high returns. So we've only got one other person on the call at the moment, Claude. I mean, if you're welcome to, um, ah, hi, let's stop share. Uh, Hi, Claude, how you doing? You're muted, on mute. I can't hear you. You're on mute. Can you turn off, put your mic on? Don't you put your mic on? Are you on a phone? If you just tap it, there should be a, just tap your phone. It should be a microphone symbol in the bottom left-hand corner. No? Unfortunately, I can't unmute you. You're using a phone. Should say audio with a picture of a microphone in the corner. Well, there he is. He's come back.
Ah,
Oh, hi.
sorry.
Good
I
to
don't know.
see you.
Yeah, you too. Yeah, no, apologies. For some reason, I had to go through settings to
Okay.
enable microphone through Zoom. I don't use
Okay.
so. But when I went to enable microphone, it just left the meeting for some reason. So,
Okay. No
how are you?
worries. Yeah, I'm good, thanks. So what did you think of the presentation? Any comments or anything, questions or anything?
No, it's really good. A bit basic for myself, to be honest with you.
Okay.
But it's good though. It's quite interesting. The one thing I learned from it is the the Excel formula, the I equals IRR, where you get the answer.
IRR, yeah. I mean, yeah.
I wasn't aware of that, but then
You
I,
weren't aware? No, most people aren't, but it is incredibly important, actually, I think.
you know, to be honest, I've seen because I think you've organised other meetups, haven't you? Uh,
Yes.
I haven't. I've been trying to get to one in person this year,
Okay.
but it's just always something else is on, and just a bit of a nightmare trying to make it really. But
Of course.
yeah,
Yeah,
uh,
so I just also wanted to say if you're interested in IRR, I forgot to say this on the call, but if you go to this property CFO's site, there's a bit here where it's got internal rate of return. There's
perfect,
a 7-minute video where I just go into it in a bit more depth.
perfect. Yeah, no problem. Perfect. I'll bear that in mind.